And we back again, guys. Before I start this lesson, guys, I'd like to first give you a notice of the scammers, guys. There's a lot of scammers now impersonating us, and to make sure that you don't fall victim to the scammers from all social media platforms, you start following us on the right channels. Now, in Instagram, guys, make sure you follow this account here, and in this account, only follow the people under the following to make sure that you don't fall for the scammers. And in Facebook, there's only one account, which is this one. And then from this account, you can only follow the posts that are shared on this account. Okay, guys? In YouTube now, there are new scammers impersonating us under the comment section below, guys. To make sure you don't fall victim to their scam, check the pinned post at the bottom of the video so that you learn on how to avoid scammers. Now let's get to the main course of the video. In this lesson, guys, this is basically lesson 2 of our free course. We included 3 chapters. Chapter 1, which is how long should you hold your trades. The reason we're including this is because, guys, a lot of traders are struggling in terms of how long should they hold their winning trades or how long should they hold their losing trades. We covered the whole chapter. The second chapter will be fundamentals. Fundamentals, guys, we never really talked about them since we started this channel, so we make sure that we cover everything and all information regarding fundamentals. And the last chapter will be indicators, guys. I do know that we've never really talked about indicators. Reason being that we only use indicators as a way of understanding the market condition, not exactly to use it as entry triggers. Before we start the lesson, guys, don't forget to hit the like button, hit the sub button, and make sure you enjoy the whole lesson. Without any further waste of time, let's get it.
So yeah, guys, now we're actually about to cover one of the most important lessons, and that is how long should you hold your trades. So when we're done with this lesson, guys, we're going to be analyzing the market together, so be sure to actually get to that point. Be sure you watch the video until we actually show you how we analyze the market. So we're going to show you how we actually use the lessons that we're going to cover from here to help you guys be able to find better entries and be able to reach your trading success. So without wasting any further time, let's continue. So now we're going to quickly cover the overview of our lesson, guys. We're going to firstly start with how long you should hold your trades, risk reward ratio, what kind of trade you're in, how volatile is the market, and we're going to finish with the 2 last topics, which is tips on holding onto your winning trades and how to find trading success. So before we get to that, guys, I want to start with the most important lesson, and that is basically being able to understand how the market works, right? So whenever you trade, guys, you have to know that every time you trade, you need to firstly start by identifying your high and your low. Basically, what we mean by that is being able to identify your support and resistance. Our support is basically our floor, meaning that we want to use the support structure to be able to know when the market will reverse, as this will play the role of a floor. So whenever we have a ceiling, we know that that basically acts as our resistance, right? As long as we're at the bottom, we're looking for buying opportunities, and as long as we're at the top, we're looking for selling opportunities. So let's say basically you're at this point and you're analyzing the market, and as you see, the market has been flowing like this, and it gets to a point where you want to enter a trade, right? So the market was pushing down towards our support structure, and you found yourself at the support and you basically wanted to go for a buy, right? So this is how you would do when you analyze. So I want you guys to know that it doesn't mean that because I analyze like this, the market will move exactly like that. You're gonna see it's actually never the case. When I analyze, I'm only using the past events to help me be able to find highly probable trades. Though I said the market will move in this direction, it doesn't mean it will move like that exactly. The market will decide how long it will take for it to reach that point. As you can see, it's up to the market to decide how long it will take to reach your level. When you choose a direction, you're only just choosing the direction and not how long the market will actually reach your level. Meaning that, guys, as long as you're gonna be trading here with us, when we talk about Forex, that time is irrelevant, meaning that whenever you enter a trade, don't say that because you entered the trade today, you want it to close on the same date. Only the market will decide when to close. You'll get to see that the only thing that matters in the Forex industry is, of course, volatility, right? Volatility is obviously made by what? the power of buyers and sellers. That's what actually causes the market to move. Meaning that whenever I'm going to be trading the Forex industry, guys, I have to know that it doesn't mean that because I want to go for a direction, the market should move exactly like that at that time. So let me explain to you what I mean by this. So you'll find yourself that the market was moving like this. When the market moves in this kind of manner, we call it low volatility, right? However, when the market gets enough strength and it starts shooting up like so, we call this high volatility. Such movement is caused by the market, meaning that there will come a time when you're going to enter a trade here, of which the market will become too volatile, and this is where you're going to be able to make a lot of money. However, if you're going to now start forecasting for the future to say it will always happen like this, you'll be of course incorrect, because there will also come a time where you're going to enter a trade and you have to hold for at least a few days, if not hours, until the market moves. So we have to understand that volatility is something that is actually caused by the market, and that is something we cannot control. Time is irrelevant. The only thing that actually moves the market is volatility. As you see, guys, before we start our lesson, it's important for you to understand how the Forex market works. So I quickly brought you here, guys, because I want to explain something that I think it is very important for you guys to actually get to understand. So we know that whenever the market approached this level, we were looking for buying opportunities. As you can see, guys, this is acting as a support structure for this buy trend. The market is now going on a bullish momentum and it has an uptrending support, meaning that this is still our floor. However, it is still uptrending. Should the market cross it, it's going to become a resistance, right? So I want to cover a simple concept real quickly for you guys to understand. So I want to quickly cover, guys, what this actually means. So this S here stands for support, meaning that as long as we're still above this line here, we are looking for buying opportunities. Only when we cross, that's when we're going to look for selling opportunities, meaning that our floor will become our ceiling. As long as this is a floor, should I cross my floor, it becomes a ceiling. Equally opposite, if this is basically my ceiling, should the market decide to actually go and cross this level, it will now become a support. Whereas in this stance, our ceiling becomes our floor. As you can see, guys, it's important for you to be able to understand these concepts, as you can also use them to enter some trades. So now back to our chart, we see that there's an uptrending support structure. The market has broke support and now it's beneath it, making it a potential resistance. Hence, this is one of the indicators that I might use to help me find a sell entry. So I see that I'm expecting the market to sell at this point. So this is my direction. As you see, guys, I'm expecting the market to sell in this direction. I'm not saying the market will actually sell exactly like this or as quickly as my arrow dictates. No, we do not lead the market, we only follow. So I'm only following the trend. As the trend moves from a buy into a sell, I'm only entering my sell trade and choosing my direction. However, the length or the time it will take to reach my point, for that I cannot control. So let's see what happened. So as you can see here, guys, the market actually came back up. As you can see here, the market came back a bit. I went to some bit of losses, and from there it decided to push back up and to come back and retest that level, which is basically, if you look by the past event, it was of course more of a ceiling. As you see here, guys, we had a potential market ceiling there where the market came to retest our ceiling and dropping as the overall sell. As you can see here, guys, whenever we say the market will be dropping, whenever we're going to be analyzing, we cannot choose or dictate how fast or how long the market will take. That will depend solely on the market. The only thing we can do is only choose the direction the market would head into. Let's look at the next example. So if you look at this example here, guys, I analyzed the market and I basically saw my nice buy trade and I want to go for a buy, and I made my analysis, you see. So here from my analysis, guys, what do you think? How long do you think it will take for me to actually come from here and end up reaching this point? So I want you guys to understand that is something that we cannot control. We just have to wait to see how the market actually plays out. As you can see here, guys, the market actually took a longer time. As you see, there will come a time where you're going to be holding your trades for a bit longer than expected due to low volatility. As you can see here, guys, we experienced some bit of low volatility and the market became volatile and then came back down again with low volatility and then shot back towards our resistance structure and completed our setup. So this is something that we cannot control, guys. Volatility is determined by the market. We cannot control that. The only thing we can do is basically follow and take what the market gives us. So now that you actually understand this concept and how time works with Forex, we can continue with our lesson. So now guys, we're going to be covering how long should you hold your trades. So the first one we're going to start with is risk reward ratio. This is the most important because it will actually determine your overall growth in the forex industry. So the first thing is basically having a positive or a break-even risk-reward ratio, meaning that guys, we actually want to focus on the fourth and the second quadrant, right? We want to have low risk and high return, low risk and low return. You should never find yourself having a high risk, high return, and this one is even not an option. So don't ever find yourself using this quadrant. You can only use this quadrant when you have money that you're actually more than willing to lose. If you're going to be doing some small challenges, that's when you can go for this quadrant. However, for you to actually trade safe, it's important for you to actually use low risk, as in order for you to win in forex trading, you're going to know that risk management is also one of the most important factors that you must always cater for. So now, what does positive risk reward ratio or neutral risk reward ratio mean? We want to make sure that each trade that we take, we're actually going to be willing to win 2 to lose 1, meaning that when I trade, I want to make sure that my analysis is in a way that I'm actually willing to win 2 and lose 1. As you can see guys, this will be an overall growth. As long as I know that I'm losing 1 and having an overall win of 2, my market will grow indefinitely. As we know, 1 will represent my losses and 2 obviously will represent my winners. So in order for us to apply this, we need to know that we have to actually stick to 3 points: SL, TP, and entry points. Meaning that guys, if you find yourself being in a position that you want to go for a buy, you have to know that you must be willing to lose 1 to gain 2. Meaning that if I want to go for a buy here, if it's a buy position, I must know that my stop loss must be at a level where I want to lose -1, but get to a point where I'm willing to actually win at least +2. It's important for you guys to have an overall positive statistical advantage. So the second thing we're going to be looking for guys is what kind of trade you're in. You have to know what kind of trade you're looking for, and the 2 types of trade that we're going to be using is either you're going to be swinging or scalping, and that will actually help you know how long you should hold your trades. So what is a swing and what is a scalp? To swing is when you're going to hold your trade for more than a day, and when you scalp is actually when you're looking for some active trading where you're going to be quickly in and out of the market. So being able to understand that can actually help us a lot. So how can we actually use this information in a way that we can understand it? Let me just make a brief example. Let's say, as usual, we have our resistance at the top, and we know that we have a support structure at the bottom, and basically at this point guys, we're actually analyzing this from a weekly perspective, meaning that we're analyzing from a very bigger time frame. So the market can actually do this, right? You can find a time where the market does this. What do I mean by this? How can you understand how to swing or how to scalp? So basically guys, what scalping is focusing on such small trades. It's basically going to smaller time frame where you're going to be analyzing the market only at the current moment, but on a smaller time frame, not looking at the overall. So basically this will be your now resistance, and this is going to be a top. As you can see, the movement is going to take now a short period, whereas if I'm actually looking for a swing trade, it's going to be a bigger time frame. It's going to take time to come from here to here, but it will take a shorter time to come from here to here. So when I scalp, I'll be focusing on those small things, but when I swing, I want to actually catch the whole movement. So as you know, when you trade, you have to understand if you are a patient person or you want to be more of a scalper who's going to be in and out of the market. So lastly guys, the most and last important one is basically volatility, right? So in your case guys, luckily we have covered this one, so you already know how the volatility works. As you can see guys, all these 3 actually help a lot in knowing that how long you should hold your trades. As you know, risk reward ratio helps us being able to know that we're going to be having an overall win. Scalping is to know which trade we're going to be taking. Are we going to be looking for a scalp or a swing trade? And lastly, is the market volatile or not? So without wasting any further time, let's continue. So now guys, we're going to cover the tips on how to hold on to your winning trades, right? So in order for you to do that guys, you need to know that you need to firstly identify your exit point, right? That is the most important, as you're going to need it in order for you to know when to actually close your trades. So for you to know on how long you should hold your trades, you're going to be able to do that knowing that you know when to close it. That's how long you can hold that trade. You're not going to close due to time, but you're going to close due to a level that the market must reach. You understand that because we covered it. So now the next thing that you need to know guys is scaling in. What is scaling in? So when we talk about scaling in, guys, basically that means we are adding to our winners. So let's say the market is currently at this point and I'm going for a nice buying position here. So I'm analyzing the market and I'm seeing that I want to go for a buy. This is my direction. I've identified my support structure and I've seen my resistance structure, and I'm seeing the market is now going for potential breaking of this trend line that we see here, and we're expecting the market to actually push to the upside and test the overall resistance. So I'm going for a buy, entering my buy trade, and the market goes up. So I see that the market pushed up. Now I'm seeing basically where the level has been crossed and the market is now playing in the zone. I still have my buy trade here. So what is scaling in? Scaling in is when you add another buy onto your winning trades. Meaning that, guys, most of the time, many people only add more trades onto their losing trades. And that is how their losses always become more. How the world works, like, that's exactly how the Forex market also works. Watch your focus on growth. So if you're going to be focusing a lot on your losses, if you're going to be adding on your losses, busy being on your screen for your losses will be more. If you're going to be focusing a lot on your profits, being able to increase your profits, working a lot on your profits will be more. Watch your focus on growth. That is the most important concept that you're supposed to know, and that will help you a lot as a trader. So we see that the market here, we've entered a buy, and it gave us another buy position, we've entered another buy, and that's basically when we're scaling in, right? As long as you see a nice position to enter another buy, you're going to enter a buy. Here it's going to be basically a nice buy entry. Here is upon retest. This is here upon break of a trend, and here we basically close the trades with a nice scaling in method. So now, guys, what is scaling out? So when we scale out, guys, is when you have a bigger position running. Let's say you have big profits. However, you want to hold until a specific level, right? So when you scale out, you're basically decreasing the amount of profits that you have on your running trade, meaning that you're actually closing half and leaving the remaining half in your running position until it actually hits the final exiting level. So next, you're going to cover setting trading times to review your trades. This is one of the most important that you actually guys must know. Many people think that when you're going to trade Forex, you have to be on the screen the whole day, sleep, work, repeat, sleep, work, repeat, which is not the case. When you trade, guys, you're going to see that you need to have a time where you're going to be analyzing your charts. It can be in the morning, you're going to be analyzing your charts, and then you're going to find your time. It can be in the AMs or midday where you're going to enter your trades, and then you're going to have a time you're going to have to let your trades run, as they have to do they take their course, and then you're gonna come back and then check at a different time on how the trades actually went, and that's how we actually go about trading. So the last and the most important thing, guys, is basically staying away from the charts. This one we've been covering it over and over again, knowing that if you're gonna be glued to the screen, guys, that's how the Forex market will get to work you. That's what's gonna make you actually change your overall plan, and you're gonna end up being a losing trader. So now we're done with this topic, guys. I hope you're enjoying the lesson as it is. We can continue, and remember, after covering all this lesson, guys, we're gonna be analyzing the market together. So last but not least, guys, how to find your trading success. I'm gonna wrap this as quickly as I possibly can. So the first thing that you're actually gonna need is to firstly identify a proven trading concepts. For example, we can use breakouts, or you can use high and low. What high and low is basically be able to find the low for a specific day and the high for that specific day. So now, secondly, you need to develop a strategy around your trading concept that you might have found. So you have to see how the market works, and you're gonna find a way to make sure that you're gonna back test that strategy, which is step number 3. You're gonna be validating your strategy and back testing and seeing how you can actually make it work. The last and the most important tip is to always put yourself in an environment where you will stick to a trading strategy no matter what. So it's important for you to actually find a strategy that suits your trading style, and you're gonna work on it for the longest time. And apart from that, guys, stay tuned for analysis. I hope you enjoyed the lesson. Let's get more into it. Yeah, so welcome back to the charts, guys. So today we're going to be covering USD CHF, also known as the dollar Swiss. So we're going to be analyzing this market all together, guys. So you're going to see from our analysis, we always analyze from higher time frame and we go to smaller time frame in order for us to actually identify our entry points. So we use higher time frame to know the overall direction, and we go to smaller time frame in order for us to find nice entry points. So without wasting any further time, let's jump in. So now, guys, we are looking at this dollar Swiss on a weekly chart. So we can see that the market was actually coming from a bearish trend. We can see that the market was actually pushing towards the downside, and we go to the level we experienced some pushback. As you can see now, this became a potential support structure, right? Let me go a bit in for you guys to be able to see properly. So first things first, guys, we saw that the market actually reversed here, came back up and reversed one more time by actually giving us a nice exhaustion or a pullback at this potential price movement. So now let's look at this. We are seeing that this can now be able to be used to identify our support structure. As we can see, the market reversed at this point and another time here, making it now a more stronger support level. So that's how when it came to this point, we knew we were looking for basically a support structure. So what else can we see at this point? We can see that we have another support structure, of which if we can put this here, we can see that this is basically a level that we want to cater and focus on, right? We do have a nice support structure here because this is where the market usually reverses. Again, guys, we can see that we also have a nice resistance structure here. Once again, you can see that this is where the market usually reverses at the top. So now we can see from a weekly point of view, we were able to identify our high and low. This is basically being able to identify our major support and resistance, knowing that for now we're still under this nice playground, right? And if we go more with trends, we're gonna see that we are seeing a nice strong resistance here. We can see here the market also tests this level a lot, as this can become for us a nice potential resistance. As we can see from the market previously, we're using the historical price movement in order for us to be able to understand the next potential price movement. So we know that if the market should approach this level, we're going to look for a potential sell, or if we cross this line, we're going to look for potential buys until this point. That is one of the ways we can use analysis in order to know how long we should hold our trades and when to exit. So we know at this point you want to exit a sell, and at this point you want to exit a buy should the market push and cross towards this resistance structure and actually in the final resistance at that point. Since we identify this level, we need to sink in a bit deeper and see if the market is actually going to go for a buy or a sell. So in order for us to understand that, we need to know what the market did and if we were still under the buy or the sell zone. So how do you go about doing that? I have to go zoom out and see that the market was actually selling, and from this point of view, guys, I can actually see that the market has still once again formed for me a nice small resistance. So usually, guys, we don't like to actually put in a lot on our charts, but at this point it's important for you guys to actually have this, as I want to be able to explain everything more in depth for you guys to be able to understand why we actually take some positions and why we actually take some potential movements. So I'm going to change the color for that one. As you can see, now the color is in a way that you can understand. So we know that apart from just being below this resistance, we're also below this downtrending resistance, meaning from an overall weekly perspective, we're still under the selling opportunity. Because if you look closely here, the market was tested twice. If you can see, it's 1, 2, and coming back again to confirm that retest here, to knowing that we have now an actual downtrending resistance, right? So now let's go in a bit deeper and see what else can we do with this analysis. So we're gonna go into the daily chart and see what the daily has in store for us. So we're now in the daily chart, guys. So you can see the market has hit the bottom here and it has hit the top here. So we need to understand how did this happen here, and basically I'm still seeing something here. I want to show you quickly. I'm seeing that before the market came here, it actually had to break first towards the structure. So I want to change this a bit, guys, so that they don't actually confuse you, so that you know which is which. So we see that the market here actually crossed this level here. So I'm just going to put this like this, guys, so that you understand. So I'm seeing the market here was still on a nice buy trend. As long as we're still above this, we're looking for buys, and on a cross we're gonna go for a sell. Usually we like using this analysis, guys. As you know, most of the time that's how we analyze our pair. So we have to make sure we're catering for most touches as well. So we knew that as long as we're still above this up trading support, we're gonna look for buys. But when we cross our support structure, it now becomes our resistance. Hence, that's why the market would have sold. You would have entered a sell here, and you knew that this was a potential support structure. So for this analysis, you already knew that if you were to enter a sell here, you would have wanted to close, or you would have wanted to hold until this point right here. So what else happened? I see that basically for that to happen, guys, the market was actually on a nice buy trend. Let me quickly do this for you guys to actually understand and see what I'm talking about, right? You can see that the market was still on a nice buy trend here. So how can this work in a favor? We know this is an uptrending support, we know this is an uptrending resistance, and this here we have a small breakout because the market was just testing this overall resistance structure. Apart from that, everything is within our resistance here and our horizontal resistance as well. So the more I dive into the charts, guys, I can see that the market has more significant levels. So I can see if I put this here, I can easily find my significant level at the bottom here and this one here. So I'm using all these instruments in order for me to understand what the market is doing, guys. I hope you're able to actually get to understand what's happening here. As you can see, the market is still under the setup, right? If you look closely here, guys, you're gonna see that should the market actually get enough momentum to push, making a nice head and shoulder here, it can be able to push and break towards the structure, knowing that it broke this major resistance and the overall weekly resistance. Therefore, we are now in the buy trend. We are back inside this buy trend here. So that happens by a power of retest. And after retesting, guys, we know from the point of view that we are now going to be looking for buying opportunities until the market actually reach that overall selling point, right? So that's what we'll do when we look for a buy. Should the market cross here, we knew it's going to be a buy. It's back inside the buy trend and it has crossed both our resistance. We're going to enter buy. It's going to be a strong push to the upside. And for those who don't see the head and shoulder that I'm talking about, I'm going to quickly show you what I mean by that. If we dig in deeper here, guys, you're going to see the market actually came from here, went back down, came back up to retest this level, went back down again, came back to retest this level here, went back down, and now it's forming a potential head and shoulder. So since we're still under this position, guys, what I'm actually looking for is opposite of that direction. What I'm looking for currently, guys, I am now looking for what we call a nice selling opportunities. Why do I say that? I'm seeing that the market has the possibility of actually retesting this point and actually dropping towards this level. And for the market to reach a level, it will be testing the overall support structure. So for that, I need to confirm. Let me go to the weekly time frame quickly and show you what I mean by that. If you need to identify the overall support structure, you can see here as well, is still support structure here as well, guys. I don't know if you guys can see it in the touch, and that's basically the low of that. So meaning that because we're still under this resistance, guys, we are still looking for selling opportunities.
Hi there, this is FXGOATS, your Forex mentor, and in this lesson, we'll be focusing on the introduction to fundamental trading. Now, without any waste of time, let's get started. Firstly, let's start with the definition of fundamental trading. Fundamental trading is when a trader focuses on economic events to determine which currency pair to buy and when to buy it. It is a way of analyzing potential moves of a currency through the strength and weakness of that country. What I mean by this is the fundamental trader uses economic events, which is also the macroeconomic indicators. They are specifically the news events which affect the market by creating high volatility movements. Now, the degree of that volatility will depend on the importance of that event, which is why you need to understand the importance of the specific news events and what they actually represent. I actually said here, it is a way of analyzing potential moves of the currency through the strength and weakness of the country. So let me give an example of what I mean here. Let's say, for instance, we have the US news, which represents the United States of America. What we need to know first is that the US usually has the biggest impact on the market because the US is the biggest economy in the world. So what happens, let's say, for instance, the US gains strength. Let me show you here. Let's say the USA gains strength based on the news affecting the market. Firstly, let's say we have two types of currency pairs. Firstly, we have the USD XXX, and then the next pair we have here is XXX USD. So what happens is when the US is actually a base currency of a currency pair, we're looking for what is so-called bullish movement when the economy gains strength. And then here, when the USA is actually a code currency, and then the economy gains strength, that means you're looking for what is so-called, which is vice versa if the economy actually loses strength. That's what I meant when I said the potential movements of the currency through the strength and the weakness of the country, okay? So let's continue. Trading on fundamentals is more of a short-term trading, unlike technical trading, a scalper trader. What I mean by this is a technical scalper trader is a day trader, of which they can trade up to a whole day trading, as to where a fundamental trader can only trade up to 10 to 15 minutes a day, or depending on how many news they have on that day. Hence, I said it's a short-term trading, unlike technical trader. The fundamental trader use only 15-30 minutes to only analyze the charts and enter pairs. So that is all for the introduction of fundamental trading. Now let's go to the next slide. Okay. News events we are likely to trade. The news events we are likely to trade occur on the macroeconomic indicator, meaning the overall view of the economy. Firstly, on the news events we're likely to trade, we have what we so-called the USD news. The USD news, firstly, we have what we so-called the NFP. The NFP stands for the non-farm payrolls. The non-farm payrolls focus mainly on the employment change of the USA, meaning how many people are employed and how many people are unemployed. So we are able to identify like how many people actually contribute to the USA economy. They're very important and they usually have high volatility movements. Now, when do we find the NFP news? The NFP news, we usually find them on each month in the first week on a Friday. Okay. Now, secondly, we have the CPI and retail sales. The CPI and retail sales, the focus for both of them is mainly based on consumers, meaning for the CPI, we're focusing on the price of the consumer goods and services, meaning are they able to buy and is the economy able to make profits? And then on the retail side, we're focusing on the consumption spending of the consumers. For instance, like are they able to spend? Is there circulation flow of money in the US economy? As you can see, guys, they're very, very important as well to the economy, and henceforth you must trade them too. Now, lastly, we have the FOMC. The FOMC stands for Federal Open Market Committee. Now, they have very, very high impact and they're very important to USA. They usually have even high volatility than the NFP and also CPI and retail sales, because the federal committees focuses mainly on the interest rates and the money supply of the economy, like the overall growth of the economy. Hence, they have the biggest impact when it comes to the forex market. They don't care as much as the NFP and these two right here. So when they do okay, make sure that you trade them, as they can double accounts or even blow if you don't know what you're doing. Now, that's all for the USD news. So the pairs that I normally trade in the USD news is usually first the USD JPY, the USD CHF, and then that's when the USA is actually a base currency. Now let's say USA is a code currency. I usually trade on the GBP USD and then Euro USD. So those are the pairs that are actually most affected by creating high volatility movements when there's news for USD. Okay, so that's all for the USD news, guys. Secondly, let's go to the Australian news, which is the OD news. Now on the OD news, firstly we have the employment change, which is similar to the USD news, meaning when there is employment change, we're focusing on how many people are working and how many people are unemployed, because we want to identify like how many people actually contribute to the economy of Australia. So secondly, we have the CPI and the retail sales, which is also focused on the consumer spendings, which is important too. And then lastly, we have the GDP here. The GDP stands for gross domestic product, also important to the Australian news because it represents all the goods and services produced within a year and how whether that affect the economy, meaning if the GDP is better than last year, that means the economy is doing well, meaning we produced more goods than last year. If the GDP is lesser, that means the economy is doing bad, meaning the economy is less competitive to itself or other countries. Now, let's speak of the pairs of Australian news. So the pairs that I usually trade on Australian news, firstly, when OD is a base currency, I usually focus on OD Japan and OD USD. And now let's say OD is a code currency, I'll focus on what is so-called Euro OD only. So those are the pairs that I only trade when you have OD news because they tend to have high volatility movements. Now, that's all for the OD news. Now let's go to NZD news. Firstly, before we start with NZD news, I want to tell you guys that the NZD news doesn't occur as much as the OD and the USD news. So when they do occur, make sure that you do trade them. And then under the NZD news, we have the employment change and the CPI. I did explain about the employment change and the CPI. We focus on the unemployment rates and the employment rates of the economy. And here we focus on the consumer spending and the prices we have for the economy. So these are very, very important indicators for the New Zealand news. So okay, the pairs that we trade for NZD news is we're focusing on NZD USD and then NZD JPY. Now let's say now is the code currency. We're focusing on Euro NZD. That's only the pairs that have high volatility movements when there's NZD news. Okay, now that's all for the left hand side, guys. Let's focus on our right hand side. Now on our right hand side, firstly we have what we so-called CAD news, Canadian news, which is from Canada. Before we continue, I want to tell you guys that there's a link between the USD and the Canada news. So every time there's NFP, on the NFP day, there'll always be Canadian news as well at the same time. So the pair that joins these two is actually USD CAD. You see, USD CAD is a very powerful pair, guys, because it contains one of the two biggest economies. Okay, secondly, we have the employment change that did go through in this last three. Focus on the employment rates and the GBP. We're focusing on the goods produced. And then lastly, we have the BOC rate decision. What the BOC stands for, it stands for the Bank of Canada rate decision. Now, the Bank of Canada now is important to the CAD because they focus on the central banks of Canada, meaning they focus on the interest rates, they focus on the investment plans, they focus on overall growth of the economy, meaning the circular flow of money. So they're very important to the economy of the CAD news. And then they also create what is so-called high volatility movements. Now, lastly, on our right hand side, we have GBP news. On GBP news, these are news from England, so which is a very big country too. So firstly, we have BOC rate decision. What BOC stands for? It stands for Bank of England rate decision. Similarly to the CAD news, BOC focuses on the interest rates, the central banks of England. These are very important news to the GBP economy. Then I do advise you to actually trade them all, okay? Or when they do, okay? So now, the pairs that I trade with the GBP, firstly, let's say now GBP is a base currency. I'll be trading on GBP USD or GBP Japan. Now let's say now GBP is a base currency, Euro GBP. That pair is very volatile, doesn't normally follow setups. Now let's continue. Now, all these events updates, you can find them on investing.com app. If you're using an Android, you can find them on Google Play. And if you're using an iPhone, you can find them on Apple Store. Now, let's say, for instance, now you're using a laptop, you can find them on my FXGOATS website. Now, I want to show you guys how to actually set up your investing.com app on how to only have high impact news. So without any waste of time, guys, let me show you what I'm talking about. Right here, I have a clip of showing you guys how to set up your investing.com app to only have high impact news. Now, in order to have high impact news in investing.com app, you need to make sure you have only 3 bulls. So 3 bulls in this investing.com app represents high impact news. Let me click on the video. As you can see right here, we enter the investing.com app, we go to calendar, then go to the icon up there, and then we can see we have different types of bulls. You must make sure you only have 3 bulls, which represents the high impact news. So this is how you set up your investing.com app to only have high impact news that create high volatility movements in forex trading. Okay, now let's go to when you're using my FXBook. Now, for instance, let's say you're using my FXBook. It's a website. You must type in the website myfxbook.com. So now let's say you do type the fxbook.com. It might take you into home, but make sure now you must go into economy calendar and you will be here. Now, once you're here, guys, you also need to have only high impact news. As you can see right here, we have different types of impacts. We have the non-impact, the medium impact, and the low impact. To make sure that you clean your news to only have high impact, you come into this more option right here. And when you get this more option, you must remove the medium, the low, and the no impact at all to only have what is so-called high impact news. Now you scroll down and save. And as you save, you only see there's only now what is so-called high impact news. As you can see here, now we have a cleaner view of your news impact, and then you're able to trade your news easily, and you can plan your trades being a fundamental trader. So let's go back to our PDF.
Now let's go to the next slide. On this slide here, we have types of fundamental trading styles. Firstly, you must understand which style you need to use in order to profit when news occur. Firstly, we have pending orders. A pending order is an order that is activated or filled when the price buy hits the price where you set it on. E.g., we have limits, buy or sell limits, and stop orders, buy or sell stop. Now, in pending order strategy or fundamentals, we only focus on stop orders, the buy or sell stop. Now, I want to show you guys how you can use pending orders in order to profit in terms of being a fundamental trader. Now, the stop order is for those who actually don't want to estimate the direction of the market, so they're trying to keep it safe. Now, let's say, for instance, the market is ranging in this manner. Okay, it's in a downtrend, and then we're looking for bullish movement, but you're not sure whether it's going to occur or not, so you want to remain safe. So what you do is you first set your buy stop right here, and then you set your sell stop right here. After setting your sell stop and buy stop, you make sure that you also set your take profit for the buy stop and the
take profit for your sell stop. So now let's say the market is right here. We're waiting for the news events to occur. Let's say they're occurring at 2:30. They'll actually activate your stop order and now hit your TP in order to trade. Now let's say the news didn't actually go for a bullish movement. It went for a bearish movement. It'll activate your sell stop order and then how hit your TP. Now, the only problem with this strategy is that you don't get to actually profit from the volatility movement. As you can see, you only catch the small spike. This is the safe part of catching the fundamental news, but as you can see like here, it will provide you with less profits. Now, the market execution focuses on M and W patterns. Firstly, let's start with the M. The M is created on a bearish reversal pattern, meaning the M pattern is not complete until the price breaks out of the M or support. Firstly, what you need to know about the M is there are 3 types of M's. Let me show you what I mean. There is what is so-called an increasing M right here. And then we have a normal M. And then lastly, we have a decreasing M. What we have here is a high and a higher high. And here we have a high and a high. And lastly, we have a high and a higher low. So both this increasing and the decreasing M are very powerful than this normal M right here. So these are 3 types of M's that actually occur in the market. And M is not confirmed until it actually breaks the support level of the market. So let's say, for instance, our M will be like this. And then when news occur, that's when it will actually be complete, breaking your support level right here. That's what I meant by that, okay? So now let's continue going to the W setup. Now, the W is created on a bullish reversal pattern, meaning the W pattern is not complete until it breaks out of the W or the resistance. Similarly to the M, we have 3 types of W's. We have the increasing W, we have the normal W, and lastly we have the decreasing W. What do you have here? We have a low and a lower high. We have a low here, and here we have a low and a lower low. I prefer using the market executions because you get to actually profit on the whole movement of the volatility of the spike of the market. Now I want to show you guys how to actually identify all these patterns in an actual market. Now let's go to our charts. As you can see, I'm only using the 15 and 30 minutes charts to analyze my news. So in order to identify when the spikes occurred, you must look where the market slowed down and then actually had what we so-called biggest volatility movements. So as you can see right here, firstly, I've already spotted 2 types of W's. I have what is so-called an increasing W right here for myself. Before the news occurred, the W actually went down first, and then secondly created a spike up. A strong movement, as you can see right here, guys. It broke our what we so-called our resistance right here and confirmed to become our W setup. So this is very powerful. As you can see, you're able to catch on the whole spike of that volatility. Now, secondly, here we have also the second increasing W as well. You can see it also slowed down before the news, as you can see right here, and then also created what we so call a big spike. The reason I'm saying it's better to have the market execution is because you can see you get to actually profit on the whole movement of the market. Now let's go to the next pair we have to find or spot different types of market setups. Okay, now this time we have the gold pair, which is the XAU USD. What I see M setups. Firstly, as you can see right here, we have our declining or decreasing M. See, so it broke through my resistance. As you can see, the market slowed down here and then now it entered the pair. What this did is also it retested after going down and also continued with the spike, creating an overall down big movement right here. As you can see, guys, this is how you actually spot your M and W's in the actual market. And secondly, here we have the M here, the increasing M. As you can see, guys, here before actually news occurred, the market actually slows down, and then as you can see right here, then secondly creates a bearish strong movement. So it's very important for you guys to understand how to use this market execution and how to actually identify into the market. I want you guys to actually practice this skill over and over again. It will become as easy as it is for me for you too. Let's check on other charts if maybe there are also M's and W's to spot. So let's continue. On this third pair here, which is the USD Japan, I see W. It's hard to spot because it's not proper. I want you to know that it's not always that your W's and M's are going to be proper. As you can see right here, this is my W. As you can see here, the market slowed down before creating a small spike. I did tell you that a straight W doesn't normally have the same strength as the increasing or the decreasing W's. As you can see right here, you can only catch this whole spike and then This is how a W was created. Okay, now let's go to our next pair. Let's see if you can spot any W's or M's in this pair here. Okay, in this pair here, I've spotted my W. I'm pretty sure you can see it too. We have my W set up right here. This is very hard to spot as well, but as you can see, I see this because I can see that the market actually slowed down right here and then created what is so-called a strong bullish movement. Okay, so guys, that's all for me. Do this over and over again, practice, and it will become easier with time. FXGOATS signing out.
So I'm going to explain what we use an ATR for, right? We use an ATR to actually calculate volatility, as volatility is important to actually know how much you should lot size on different pairs. We should avoid over lot sizing on a pair that is too volatile because it can quickly blow your account if you don't know what you're doing. So an ATR, we can see it on the side here. This is basically 12 pips for every hour. So that simply means Euro USD was moving 12 pips for these remaining hours. Now let's quickly look at another pair. So now we have USD CAD, and it was basically moving 68 pips within its daily movement. So it helps us understand how much we should lot size on different pairs. Now how to find this ATR? You can come here, you can find it right here. That's ATR. So if you put it here, you can see that GBP USD was basically moving 76 pips for the previous daily movement. So that's what we use an ATR for. So now I'm going to cover what you use an RSI for. You can find your RSI within the indicators in your customs right here. So an RSI, we use it not as an entry trigger, but as a tool to understand our market condition, right? So when you're here, this is where you're going to be looking for what we call your buying opportunities. This simply means that when your price is reaches here, it means the price is oversold and we're looking for buying opportunities. Similarly, when the price is reaches this part here, this is where we're going to be looking for what we call our buying opportunities. So now that we are on a support structure, we're looking for our buy opportunities, as the RSI is also testing one of our lows. As you can see, it's being a low before, and this is where we'll be looking for what we call our buy opportunities, right? As you can see, that's what we use an RSI for. So we can use it on multiple charts. As you can see, we have this pair here also on a support structure, and if we open our RSI, we can find that we are now looking again for what we call buying opportunities. So the market condition is telling us this price might be oversold, hence we're looking for what we call buying opportunities, as you can use it as well on smaller time frames, like in our chart. We're yet again looking for what we call our buying opportunities on USD, as we're seeing this price as being oversold. So we're now looking for what we call buying opportunities. When they might give us our entry, we want to look for our buys. So that's how we cover an RSI. So now I'm going to cover how we use a Fibonacci, and I'm going to analyze this pair using our Fibonacci indicator. So you can find it here. So I'm going to use it to analyze this pair here and understand what we use it for. So the most respected levels of a Fibonacci is of course 61, 50, 38, and 23. We use a Fibonacci to understand our key level structures. So we can use it with different indicators to understand the market condition. So let me say, for example, I want to use a moving average of 200, as you can see. So when the price crosses our moving average, I can look for certain opportunities. So I can possibly see that the market is creating what we call some momentum to actually break through this support structure here and look for a sell up until our 100. So that's how I'm going to use my Fibonacci. And how you draw it, you need to find your possible low and you need to find your high of the pair that you're analyzing. Now let's look at different pair on how we use the Fibonacci. So with GBP/USD here, as you can see, we saw the low and the high there, and we're using Fibonacci to identify our key levels, and it should never be an entry trigger. So as you can see, when we look for our buy opportunities, you want to pay attention to this level here, for it can reverse as well. So let's look at another pair using the Fibonacci one more time. So we have this nice pair here, Euro USD, and we use the Fibonacci to help us understand our key level structure. So we found our low here and we found our high, and let's say for example you entered our sell. We know this was a key level structures when we went down. So when you enter your buy, it's important to know these important key levels, as that's where your market can reverse. As you can see, it wanted to reverse, creating some buying pressure and pushed up and potentially reversed at 50.
So having those levels will help you know how to set your take profits effectively. So use indicators to understand the market condition, and they should never be used as entry triggers. And just like that, that's how we end our lesson. Thank you very much for tuning in. FXGOATS signing out.